Traders Live podcast.
Hello, everyone, and welcome back to the Traders Live podcast. Or if this is your first time, welcome to the Traders Live podcast, where we get guests on. They trade live for an hour and we talk all things trading. Today, we've got a great guest. He's probably one of the OGs of sort of online Australian trading, been around the traps, has a well-established Discord community and YouTube channel, and is also a great trader in his own right. Welcome, Demoniaco. How are you, mate?
G'day, lads. Good to be here.
Also joined by my co-host, Marto. G'day, Marto.
Chugs, Demo, how are you, mate?
Not too bad, mate. Yourself?
Good.
All right. I think let's get into it. If this is your first time joining, we get $20,000. We get our guest. They have an hour to trade, and at the end, they get put on a leaderboard against all the other guests. It is just a bit of fun. Also, just a reminder, it is educational purposes only. Don't do anything that you see here because you'll likely lose money. With that, I am going to go ahead and start the 1 hour timer for you, mate.
Far away.
Boom. And off we go, mate. So what approach, really quick before we get into you, what approach are you going to be showing us, or what's your plan, strategy involved in the next hour?
Hopefully to be flat. That would be just an ideal situation while having a position open. Because to be fair, today the US is closed overnight, so we've got no lead-in, so we've got no uranium moves, got no commodity moves, just generally. There's no lead-in for the Dow Jones, the S&P 500. So everything's pretty much closed, and the only thing that's open is, well, I guess the other markets like the Nikkei, the Chinese market and stuff. But really, the lead-in from the US is kind of the most important for what I do, particularly when there's no catalyst news events, such as today as well. So there really wasn't much in terms of catalyst news. So I'm really just flying blind, so to speak. I've taken one trade today and got stopped out. And I'll actually show you this on JB Hi-Fi. I think it's actually a prime example of the style of trading that I do when there's no catalyst news events. Actually, it applies to both catalyst and non-catalyst, but this is just a classic kind of trade that I take every day. And this is something I drill into the community as well in my YouTube videos, is range breaks. I think in terms of quality of chart setups, this one is just not A+, but it's pretty up there in terms of its relevance and its usefulness in terms of just trading every single day. So here I got JB Hi-Fi. Really the only reason I looked at this is because it's been stonking the last few days. So if I bring up the daily chart, it's been on a nice tear, and it's like, okay, there's going to be a pullback at some point, and today just happened to be that day where it's gapped down a little bit and it's formed a range break. So the definition of a range break is when a stock opens up and it moves in one direction and then pivots off that point, that's your range. So at the moment, the range is between open and this price here at $59, or just under 59. So that's the range. And
sorry, mate, is that the first 15 minutes you look at, is it?
Yeah, so you're looking at, this is the 1 minute chart. So that's
for that range that you set, that's the range.
So that's from 10:04 to 10:09.
Yep.
So that range is, if we look at it in real time like this, that's how it's defined. It sort of bottoms out. So we draw a pivot and then it starts reversing. So once it stops making a new low, and conversely, when it stops making a new high, if it's gone to the upside, that's the range. And then it's just a matter of waiting for the break. So as it happens, taking a short, or waiting for it to come back for the retest and shorting the retest of that range. So it usually comes back up. That'll be a nice short entry, and then what you see is it comes off, and then that's going to be the start of the position, and then it's just a matter of finding out where the take profit is. And generally it's going to be, because it's an inside day today, not much is going to happen. It's very likely going to bounce inside of yesterday's range, because again, no lead in from the US, really flying blind. So the only thing we have to go on is this pivot point from yesterday, which is the low of yesterday. So 58.69, as you can see, it gets there quite nicely. And that's it. That's pretty much the end of this particular trade. It's not very exciting. Usually range breaks tend to have much more momentum. They tend to go till about 10:45 to 11 o'clock in the morning. But this one just lasted for about just a few minutes and hit a key pivot point, and that was it. What I was hoping was to set a stop on this one, and the stop was 59.06-ish. So just above the entry point. So the risk to reward really would have been around 7 or 8 ticks to make about 30 or so. So simple trade, this one. When there's news catalyst, it tends to move a lot more significantly. It's a lot more exciting. You tend to get trades that are like 6 to 1, 7 to 1, 8 to 1. You get really good risk to reward typically on range breaks. And unfortunately on this one, I sort of just set the stop loss, decided to come onto the podcast, and I was just like, I'll just see if it runs, and it got stopped out. So that's all right. I mean, it's not like I put size on or anything, because days like today can't really put size on anything. It's just kind of a watch and react to what's happening. But it still took the short on the range break, and just set stops and kind of walked away, and that's it. And unfortunately there's no VWAP as well, but what usually happens is you end up having, once the range break happens, you usually end up having VWAP lining up with the retest as well, depending on how long it takes for the retest to happen. So we end up with, unfortunately there's no VWAP indicator here, but usually line up with the range break VWAP, and then you kind of can double down, or rather I double down on the trade as well, and then you end up with a second and then a kind of a third wave as well on days that are a bit more active and have more liquidity. So that's kind of like, if I was to ever teach someone one chart setup that you could probably do forever, it's this one. This one is just reliable, it's consistent, and there are nuances to it, such as the size of the volume that's breaking out, and there's little bits and pieces you can piece together to make this a really functional trade for you on an everyday basis. So that's one example, and hopefully I'm just kind of eyeballing just what JBH does. If it falls back under this pivot point, maybe take a short, but at the moment I don't really see anything else today. I was eyeballing Hub as well today, so this one was more of a tape reading trade, pre-market. Hopefully it loads.
Yeah, sorry, that's HubSpot. So City Index might not quite go that low.
I'm not sure if it's actually called HubSpot. I just know the ticker is
no,
HUB.
No, it's a US market.
It might be StarHub then. Sorry, the ticker is HUB, but basically the idea there was it was queued up with 10,000 shares on $37 this morning on the offer, so a negative surplus of 10,000 shares. And on the bid, there was like 1,000 shares, 2,000 shares. It was like very thinly traded, and it was just a really clean match trade, that one. So that's like a really good example as well. But unfortunately, that one, again, because the liquidity today is a bit low, so it wasn't as exciting. So I think I might just stay with JB Hi-Fi and kind of just eyeball that one, because I believe the Australia 200 is also not really doing too much. Bit of an inside day as well, so it's kind of unfortunately today is a bit of a watch and act rather than a trading day. So
that's all right. So we've obviously sort of dived straight into one of the trades that you take, but for anyone who sort of looks at your YouTube or has been around for a while, sort of those range breaks around those mid caps seem to be something that you like to be quite active in, and then in small caps as well. Is that right? You sort of have found some success there in previous years. Are those sort of the two sort of trades or two areas that you play in the market quite consistently?
Yeah, mid caps and micros. Yeah, those two. Anything with a catalyst, I'll sort of be involved in.
Yep.
I usually don't touch any kind of micros beyond catalyst day unless it's really significant and pulls in lots of liquidity for day 2 and 3. But generally it's just catalyst, and then I use that catalyst to determine the estimated market cap price that I'd be targeting, like the peak price. Okay. And then I'd use the TA, the charting, to tell me how it gets there, as well as tape reading as well.
That's all intraday?
That's all intraday.
Is there any
nothing
instances
else.
where you do multi-day holds in your trade?
No. No, I'm trying to think. There was back in the day when the conditions I found were more reliable, and that was pre-COVID. But these days, I just don't find I have that edge anymore in holding overnight. It feels like such a coin flip, and I know so many other people that do it, and I try and get it out of them to understand how they do it and what the reasoning behind it is, just to, for my own sake, just to learn. But I really haven't been able to piece together some sort of coherent strategy or anything that gives me more than like a 50% edge. So I just don't think it's worth it for me.
Demo, is that with that strategy that you just showed us there? Is that applicable to the small caps, or is that the match trading stuff?
Yeah. So this works best with high liquidity. So you might only find this works on maybe 1 or 2 micros a day. So it really demands liquidity in order for it to work.
Okay.
Yeah, great. And so do you, well, also base it on your multi-day holds. That's my bread and butter. And I can tell you the last 12, 18 months since retail's sort of disappeared and we've seen lower trading volumes across the ASX, there has been less strength in names for those continuations to play out. So I definitely don't think you're missing out on too much there, that's for sure.
Look, I'm feeling it intraday as well, right? Like market participants feel like they've dipped, their liquidity's dipped quite a lot as well. So it's across the board pretty nasty the last 18 months.
How has that affected your trading in the last 18 months?
I've had to be selective, really selective in terms of choices for what to trade. I mean, I've had far more days in 2023 that I haven't traded than ever before, like substantially more. And I count days where, I'm putting peanuts for size on to count as not taking trades. Because, if I'm making like $5 a tick, I'm really doing that just to get a feel for the market and what it's doing. So if I'm not confident in a particular chart setup or trade, if I just put in $5 a tick, I make $15 or lose $10 or something, then it's just like, I don't count that as a particular, like a trading day. That's just me trying to stay active and trying to work chart patterns intraday, trying to find setups that work. Because what I find is that if something happens once that's unusual, it's just like whatever. Something happens twice, it's like, oh, that's a bit of a coincidence. But if something happens 3 times, it's now a trend. So that's kind of why I stay on pretty much every day. Even though I don't take trades every day necessarily, let alone big size trades, it's just about pattern recognition and staying in touch with the market, because we've recently had something that's happened that's unusual, and that's now become a trend, and that's double bottoms.
Right.
So double bottoms in the last 2 years maybe have just not been a thing, right? You see a chart set up, let's say JBH in this example. Let me just clean up the chart a little bit. So something that looks like this would be a classic double bottom where it hits $59 again, and then it rallies to the upside. It's just not something that has happened in the last 2 years consistently on a chart setup, especially with news. It just doesn't happen. But now it has in the last week. I've seen it 3 or 4 times now, and it's now been a setup that I'm taking. So that's why I'm staying active and need to sort of keep looking at the charts. So now it's become, I think, let me try and find, I don't know the stock names, and this doesn't take tickers. I think CPO is an example where it double bottomed on news. If one of you guys don't mind looking up the name of the stock for CPO.
Yeah, it's CULPEO, Ulpeo Minerals.
Say that again, sorry?
CULPEO.
Coolpeo. Okay.
Too small.
Too small, is it?
Yeah.
That's all right, but that's an example for anyone that wants to look at it. There was a Catalyst News Day, and it went sideways for about 20 minutes or so, which is very unusual for a good Catalyst News event. And mind you, it's early January, so people are a little bit hesitant to put on size and to push a stock in one direction or the other. But that one double bottomed. I think it went down by 1 tick from like 6.1 was the pivot, dropped down to 6 very briefly for like maybe $50 someone put in or something, and then it sort of reversed and went to the upside really hard. I think it that ended up going to 13 cents over 2 days or something like that. I can't remember exactly, but that was like the most recent example of a double bottom on Catalyst that's worked really well. And it's one of those things where, me and my traders in Discord, we look at news Catalyst events, we go collectively, we agree on, what's going to be the stock for the day, and CPO was the only one really, and we're looking at it, we're going, bloody hell, it's almost 10:30 and the thing hasn't moved. In fact, it's double bottomed. But we had an example, two or three other examples prior. We're like, okay, well, double bottoms are actually very likely a thing now. So we're taking the actual double bottom trade. Even though all of last year, you'd never have done it. You'd look like an idiot. You'd lose money almost every time taking it. So it's all about that sort of pattern recognition for us. So.
That seems... Sorry, Marto. This seems to be I guess, a cornerstone to how you do trade in terms of pattern recognition and stuff. I mean, even for you and I, like, cast way back to the Afterpay days, and there was examples that you're putting up on Twitter, I think, where there was sort of 19 or 20 consecutive days of characteristics around Afterpay's close, and that allowed you to consistently trade that pattern until that stopped. You'll probably explain this better, but can you explain that Afterpay scenario if you can remember that?
I don't remember that one specifically, but I do remember the tightening setup on Afterpay when it was around $100 and people were like, this thing's overvalued. There's no way this goes any further. And everyone under the sun was bearish on it. At least every retail trader was. But the setup was like a tightening wedge. It was just a simple triangle pattern. And that's after Afterpay had a massive rally. So it'd go sideways in a triangle wedge. And it's like, oh, this setup has been working on other stocks. It's 2020, 2021. It's really stonky. And it was, what was it? Just give me a sec. It was an option trade. It had less than a week expiry. It broke out. And it was like an 80 bagger. And I was the only one that called it along. And it was just simple pattern recognition, just stuff that had happened before. And I was putting it out on Twitter and on YouTube. I think I made a YouTube video after it. And everyone's talking it down, like, what are you doing? What are you talking about? It's 100 and something, it's overvalued, yada, yada, yada. It's just like, yeah, but people get emotionally attached to the idea that something's overvalued. It's like, yeah, but it can still keep going. There's no reason it can't. And it's just like, here's your simple triangle / wedge pattern that occurred. And it was a volume pop on a Friday. I remember it was on a Friday. I was trying to get the option trade for like 10 cents. And it ended up going to $8 within a week. And unfortunately, I missed that one because I was a real tight ass on the trade. I missed it by like one tick on the option because for those of you who don't know, options trading, you have a bid and an ask and you always buy the midpoint. And I was like right at the very end of the offer, I put my bid in and I was like, I'm definitely going to get filled because there's never been a scenario ever where I didn't get filled on a trade like that. And unfortunately, I missed it and didn't get it because I just logged off for the day and I was just like, I'm going to get it. It's fine. I've got an hour left in my day. I'll go do something else. And unfortunately, I missed out on an 80 bagger. But
did that change your strategy after that, man? In terms of like, is it worth paying the extra half a cent?
Every day of the week. Yeah. So these days, I make sure if I see an A+ setup, I think WTC last year was that kind of trade exactly. Where I was just like, no, I need to take this because WTC was a perfect example of like an earnings play that's just ridiculous. Now, I'm not some kind of financial expert in terms of reading reports and stuff, but I think WTC was a good example of just common sense going out the fucking window. It was a stock that I think rallied 100% or even a little bit more. I might be able to bring up the chart for WiseTech actually. Mm-hmm. But it overshot so much in the space of a quarter, so from one financial earnings report to the next, that it didn't make sense. It was Yeah, it was definitely this gap down, but I'm just trying to figure out when the previous earnings report was. Basically, it rallied, whatever, 30%. Its financials were trending a few percent every quarter or whatever it was, every half year. Actually, I think it was a half year report. So anyway, it's rallied something like 40%, if not more, over the annual. It's 80% for a large cap stock. And its growth just wasn't there. You're looking at the chart, and you're looking at the data, and you're going, yeah, okay, it's going up like 5% in half year or whatever. So how do you justify a stock that's gone 100% when it's growing at 5%, 6%, 7% or something like that? Like, it's like, sure, you could bake in the future and maybe say it could be up 15%, maybe 20, but not 40 or 50. Like, that just gets absurd. So earnings report comes out. I start building my short here the day on the 21st of August, and then the next day as well. And I guess the emotional aspect here is it's like, oh, the market, might know something. Why is it going up in earnings, especially when it's up so much? But then just pulling the trigger and actually just committing to the trade and just shorting it, or rather buying puts for the downside. So it ended up being a nice little massacre, and that was a really decent payday. I mean, that's down 20% overnight. So one of the sort of the biggest sort of plays you can have is a 20% gap on a large cap stock in options. It's massive. I can't remember how many bags that was. It might have ranged from like 5 to 8. I don't really recall, but it was a pretty sick trade. But that's just like one aspect of just common sense. And I'm like, I don't consider myself having like an edge in earnings and taking these kinds of trades, but I also did the exact same thing on Commonwealth Bank of Australia. And mind you, I only take like maybe a handful of trades that are options based every year. And I caught one of the biggest sell downs in its history. And I can't remember which one it was, whether it was in 21 or 23. I caught the biggest sell down it's ever had, so it must have been this one here. It was a massive tank based on net interest margins, NIMs, were going down heavily and was anticipated to drop as well. And it was trading at all-time highs, did a bit of a triple top, it was struggling to maintain its price, and it was on a monster rally, just no pullback whatsoever. Up 75% for our largest stock on the ASX. And there was just no financial justification to keep rallying to the upside. And in fact, there was going to be my expectation was a large pullback based on the financials and based on the strength of the rally. So these are kind of what I call common sense trades. Things are going up 80% since the last financial report. It's going to come off unless it has absolutely something spectacular. But these large stocks, they don't do anything interesting in their financials. They're up single-digit percentage points. It's inevitable. So, so I take maybe one or two of these a year, and when something's overshot, you can trust me to be looking at the financial report and the analyst reports as well, and what they're expecting. And if they're expecting 5-10% and the stock's up 80%, I'm going to be buying puts.
Yeah, great. Back on the trading challenge now. We're 20 minutes in, no trades. Is anything sort of taken your interest at all? Back on JBH here.
Take a quick look, but I expect it just to be an inside day, really.
Gotcha.
I mean, the best I could hope for is perhaps a retest that's coming here. So we can also look at this as a breaker range.
Sure. Okay.
Come back as a retest. So when it comes back down to maybe 59.36, just open up a trade. And am I able to?
Yep.
Sweet.
There we go.
I'll do a limit order. Target market, whatever. Let's go 500 shares at least.
That gets you $6,000 in.
Get a starter. Gonna wait for a slightly better price. Come down another tick or two.
Love it.
Go a bit harder. Set a stop ideally. Probably looking just to about 6 or 7 ticks below this pivot point. give it some room, because the larger the denomination of a stock, the larger the stop should be. I think a good way of looking at this that I explain to some people is, I know some people in my Discord as well get a little bit indecisive on where to put a stop on a stock with, $60, the large denom. Sometimes they keep it too tight. You're looking at this just visually. You're looking at this stock and you're like, maybe somewhere here, which is only maybe like 3 ticks below the pivot point. But then divide the stock by 10, and imagine this is a $6 stock, and then or even a 60-cent stock. I mean, are you gonna buy a 60-cent stock and stop out at 59.75 or 59.5?
Yeah, okay. That's
it's like, no, way. Give it a little bit more room. Now with a stock at 60, obviously you don't want to set a stop at 59. Let's say, what would that be, like $59? That's obviously too far. But you've got to be a bit reasonable in terms of how far it can dip, because if you look at the range of every candle, you can get an idea of just how much it can dip. In fact, you can look here at this pivot point that we pointed out earlier from yesterday. You can just get an idea of just how much that is. That's four ticks. So 4 ticks would guarantee a stop out. That's 4 ticks there. So 59.32. So maybe just 1 tick below that. And that's just an example. I mean, that was a pretty key level here. And this one is probably not, there's going to be less liquidity because we're further on in the morning. It's less likely to wick down that far. So that's just kind of me talking out loud. These are like the little intricacies of the intro.
It seems to be a pretty, for that particular strategy, pretty simple, and I don't say that in a derogatory way, but a pretty simple kind of process in terms of, you don't have to think too hard about, okay, stop, it's broken out, stop here. It's not like you're sitting there managing stops or, need to watch it for the rest of the day.
No, yeah, it's very straightforward. Very straightforward. It's even better when it has lots of liquidity. Trust me, it's so much better when it has liquidity, because when something has liquidity, I find that it just respects technicals far better. I mean, that might sound like real common sense to you and me, but for the average punter, trying to do a setup like this on a stock that just an everyday stock, let's say, JB Hi-Fi, you could call it liquid, fairly liquid compared to other stocks in its peers based on market cap. You could say it's got more liquidity because it's just been on a massive tear and there's just more eyes on it, and that's why it's more liquid and this kind of trade setup can work, because it's just been on an absolute stonker. So that's kind of, even though it doesn't have a catalyst, this is why this setup can still work. And it'll be really fascinating here if it just hits perfectly and then just rallies and makes me look like a genius, 1 or 2 tick stop. But and then the question is, where's the take profit? Well, then you can look at sort of key levels from yesterday. I mean, you can open up the 2-day VWAP, which we can't do here, but that might be a sort of a level. The obvious one is the pivot from yesterday, and then if it breaks through that, then you got the close as well. So then the question is, what do you take profit? The profit target is just below this pivot point is take a partial, and then just partial out. So I don't ever try and hit out everything all at once. I think that's not ideal, because you're never going to pick the top. Now, I think a good way of explaining this is how often do you pick the top, the very top, like 1 in 10 or 1 in 20 times? Like, how often do you really pick the top? So then if 9 times out of 10 you're not picking the top, then why are you closing everything out when it's not the best place to close out?
Yeah.
So that's why I like to take partials at key levels and build on position. So if this goes up again, so obviously we've got a little thing here, so it could just add on a little bit more. Ideally, I would want bigger size. I was hoping it'd come down just a little bit more, maybe a tick or 2, so I can add on much harder to this position, maybe like 2,000 shares on top of the 500. And then from here, I'd be adding on 500 as it breaks this level as well. So it's kind of building onto the position a little bit. And another thing I like to do as well is start small to guarantee an entry. So you can just see this entry here, the 500 shares I put in. It wasn't perfect, the entry, hence why the size was small. So as it gets better and better, size up more and more, it reduces the risk to the downside. So I kind of want to get the best entry possible with the largest amount of size, and that way minimize risk, maximize reward. And if it just rallies without me and I don't get my add-on, great, I can get an add-on here, the same size, probably 500 shares, and then whatever that makes me, if that makes $100 or something, great. It didn't make It didn't make the 500-600 I could have, but not going to complain about making something. So it's a psychological thing to sort of build into the position and scale out for me. So
and that gap, Demo, that doesn't say anything to you outside of just setting the initial range.
Sorry, can you say that again?
So that gap down this morning, that doesn't convey some wider meaning to you. You just use that to start the initial range. Yep.
That's right. That's right. It doesn't mean anything because it's a non-issue of a day. Like there's just nothing going on. The US is closed. It's a gap down just probably because it's just rallied so hard, and maybe there's no lead in from the US for us to go to the upside some more. So it's just an excuse to gap down, take profits, and stay in an inside day. Now, this sort of pivot here would be a sort of a really interesting point to break, this 58.70, but that didn't happen. So what we end up doing is kind of trading inside of yesterday's range. Like, it would surprise me if it went above yesterday's close. So really the range for today ideally should be just here, just in this range.
Gotcha. Yeah, great. Mate, if we can quickly talk about your small cap stuff, I know that's probably been a bit more of a challenge over the last 18 months, but can we talk about how you would use a catalyst on a micro or small cap stock to then base a trade? Just talk me through, like, what's the basic things you look for in an announcement, the basic things you look for in terms of risk and things like that, and how that eventuates to you actually executing.
Sure. So a lot of this is peer comparison that I do. So if I have a drill result, I've put out a spreadsheet. It's the very first video on my YouTube channel. I put out a spreadsheet, and I might have been the second, but there's a spreadsheet that I put out on just everywhere, and it's the mining spreadsheet that shows you the mid, high grade, and sort of I think I put in intercepts as well, like what's a good thickness. So that sort of gives you a benchmark of whether something is considered a good drill result or not. And based on that, I got peer comparisons as well. So I know, I know based on just experience, based on trading other peers, that if I have, let's say, a rare earth announcement come out, it's got 1,500 parts per million. It's got about 20 meters of intercept, relatively shallow. It's got maybe 3 intercepts like that. That's going to get me about 15 mil market cap. So I already know the price target based on peer comparisons, because rare earths are relatively hot. They might not be as hot as they were maybe like 6 to 12 months ago, but they're still relatively interesting. And just going to add on maximum 500.
Sorry, mate, you're paper trading with too much size, obviously.
So let me just get this trade going. Did I max out the account or something? I'm having problems with... All right.
Anyway.
That's unfortunate, but...
because of your orders or something, you might have resting. Yeah.
Anyway, it doesn't matter. We'll leave it at that.
Cool.
But, so peer comparisons are sort of a key driver.
Sorry, and when you say peer comparisons, just for those at home, peer comparison being other rare earths that have previously announced similar results have moved to a certain market cap based on the results that they've announced. And so then you infer that when they put out an announcement, a new company with a catalyst, that the inference is that the company should be worth this much based on what they've discovered.
Yeah, that's right. So while I'm trying to panic close my positions that aren't filling, and this feels very familiar. So yeah, that's right. So companies will bring out announcements, and for me, it's about understanding where they peak, and that's going to be my peer comparison. So I'm going to look at stocks historically, or rather, I'll sort of have a database of where stocks have gone. Now, I'm not going to get exactly 1,500 ppm examples. I might get like 16, 1,800, 2,000 ppm, or 900 ppm. So I've got like a sort of an idea in my head of how they can move and what their peak market cap is. In fact, I've actually started writing a little database in Discord. I've got a little channel just for something I can refer back to, or other users can refer back to if they type in gold, for example, and they can see previous gold hits and what conditions, what shares on issue there is, what market cap they peak at. And peak market cap is actually the most important one. So where a stock ends up going is kind of useless information. So it's about finding out where it peaks. And now would be a good time to close out as it gets to break even, because I think it's dipped a little bit too far. It'd probably be a break and retest to the downside. But I also don't want to take a short. So yeah, that's the peer comparison aspect. So when I have a stock, like I said, 1500 ppm, it gets 15 mil market cap. That's the peak. Now there's other aspects to that trade as well, such as how many shares on issue are there? How much historical baggage does it have in the last 12 months? Are we in all-time high territory for this stock, or are we in the yearly high? And if that's the case, then it's more likely to get to that 15 mil market cap target. Now, if rare earths are particularly hot, as in it's been running in the last few weeks some stocks, then that 15 mil market cap might become something like 16 to 17. And then how many shares on issue? Are we sitting at 100 mil shares on issue? If we are, then we're probably going to get to that 17 mil market cap target. But also, how much spread is there as well? So one has to balance out spread with shares on issue, because if you have too low shares, then you're going to have big spread and people are going to hesitate. But you have too many shares, you end up with like 1 billion or 2 billion, then the stock's just not going to go anywhere. It might push from 9 mil to 10 mil and completely miss the other 5 mil on the peer comparisons. So it's actually a pretty interesting balance of information that you got to weigh. There's like a bit of a ranking system. It's not something that's like written down anywhere. It's kind of intuitive. I guess once you trade for a couple of years, or even just 1 year, if you're reading announcements every day and you're seeing the important news announcements, like stocks that have gone up 30-40%, it's important to take note of the shares on issue, the market cap target, the peak market cap, the drill results that it's had, and just build a database of just like understanding where it can go. And then not only that, but the different types of that one particular commodity that you can have. So I only learned this one recently because it burnt me so much, is ion clay, or ionic clay for rare earths. 1500 ppm is decent, but 1500 ppm for hard rock or carbonatite is absolute garbage. So you're going to need like 3-4% for that thing to move to 15 mil market cap plus. So I got burnt on that because I just thought, hey, 1500 ppm of rare earths is, they're all the same, but no, they're not. So same thing with lithium. You got spodumene, you've got what's the one starting with L that no one likes? Lepidolite. And it's important to understand those differences as well. So that's kind of what I do in the spec end, is really analyze maybe like 5 aspects of a stock before I take the trade.
Yep. If I was to just summarize what you just put to us as if you were to see an A+ setup in this end, it sounds like the drill results are very good. They are good drill results. If you look at the left-hand side of the chart, there's no historical baggage. And what you mean by that is there's no, there hasn't been a significant move to the downside where you have people that are still in positions who may want to exit.
Up or down, but yeah, basically high volumes.
Yeah, okay. And so you sort of almost want ability for it to be fresh, new. There hasn't been an existing sort of overhang of supply. You want a good amount of shares on issue, which is a balance, and that good amount of shares on issue looks like it's liquid enough so that spreads are, I guess, quite as tight as you'd like, without there being risk of someone hitting a spread and it gapping down X cents. But then you also don't want the shares on issue too high as to the point where the stock doesn't move. Does that sort of summarize that? Is there anything I'm missing there?
Yeah, that's pretty much bang on.
Yeah. And then, so how do gaps work? Because you might obviously get, other people might ingest this information and the stock might gap 20%, 50% or something like that. Where do you sort of see that risk reward not playing out anymore?
So big gaps are interesting. They're a big psychological barrier for some people. So this is where peer comparisons are important, because you can understand, if that 8 mil market cap stock is gapping up 30% or something. So it's opening up, let's say 11 mil or 11.5 mil market cap, but the peak value is roughly 15 mil. You've got a lot of room to work with on that gap up. So that gap up shouldn't be a factor to scare me off. Also, a rule of thumb is the larger the gap, the bigger the rally tends to be. I know some people think of that as a bit unintuitive, or they might think of that and think of the times where they've got caught in a gap up and get burnt. So a lot of people kind of hesitate with gap ups. But I think the general rule of thumb is the bigger the gap, generally the better the performance, provided you understand the news. If you don't understand the news, big gap is going to scare the shit out of you. So it's a combination of learning the fundamentals and what they're roughly worth compared to, just going in blind and it's a big gap up. Therefore, Demoniaco says it's a big rally. I'm just going to go long every time. It just doesn't quite work like that. There's a bit of nuance there. And look, it's not just mining as well. So some examples of non-mining catalysts is FDA approvals. So there's an understanding the difference between FDA approvals and FDA clearance. Some traders clearly haven't got the memo that FDA clearance means nothing. A stock will gap up 25%. And that's exactly a situation where you don't want to take the match because FDA clearance is garbage. FDA approval, different story, different kind of de-risking, and a stock can really just shoot up to the moon. Doesn't matter what the market cap is. And then you got another example of court cases. I love court cases. They happen like once a year. They're a very sort of niche trade, but I saw it once back in the day, like 2016-ish. I saw what happened and I was like, oh, I'll keep an eye out on this. Very interesting kind of news. It was something to do with Mongolia and train stations or a train line being approved or something like that. This was back in 2016. I can't remember the ticker or anything. I just remember it was something in Mongolia with trains. And then it got approval and it was a court case that came out with a very positive outcome. But if you look at the stock's history, it was getting beaten down hard. It was something like $1 and dropped down to 20 cents or something. So a positive court approval launched it to gap up 30 cents, so plus 50%, and then just launched to 50 cents, 60 cents. It was basically an intraday bag. So those are the kinds of trades I take as well. So it's very niche. It doesn't happen very often, but a beaten down stock on a bad court case that came out with good positive outcomes is a massive trade for me. I take those every single time.
Okay. Mara hates court cases, so that's really interesting.
Really?
Nah, just joking. He's fine.
My loyals will be in touch with you, Jokes.
My bad. The only other thing on that is, and I see you mention this quite often, just in chat and things like that, around psychological levels in terms of there's certain price points that have either a pull or a resistance. Can you just quickly talk to us about how those characteristics may influence how you trade and execute these sorts of trades?
Sure. So a stock on Catalyst, and this isn't necessarily a day one thing either. This can go on for 2 or 3 days. But a stock that has Catalyst around the 5 cent level, 5 to 6 cents. When they have Catalyst, they launch to 8.4. For whatever reason, once a stock hits 8.4 cents intraday, it practically always gets to 9.6. Now, when I say 9.6, I'm talking like it feels like about 95%. And then 90% to get to like that 10 cent level. Now, it depends on the heat of the market and the spec end, but sometimes that 10 cent level is just a massive magnet. Like people like to push it to 10 cents. I don't know why, I don't know how, and I never really cared to find out. I just know that every time a stock gets to 8.4, it's very likely going to push to 10. I don't care what the news is. I don't care what the market cap target is at times. If the liquidity is strong, if it's hot, then once it gets to 8.4, it's just going to get there. Now, there are some circumstances where the market's a bit quiet. Let's say, the first week in January, and you get this kind of move from 6 cents to 8.4. From there, it might move to 9.6. That's sort of like what I'd call a secondary target. Usually, if it breaks 9.6, it gets to 10. So it's one of those two levels. It's either 9.6 or it's 10. It's about judging where how hot the market is. So you might have seen last week, you might have seen a couple of 10 cent rallies. and they've even broken through and gone to 13. So it's pretty interesting. But there's that level. There's the dollar level, the $2 level, because $2 is where it starts going from half cent ticks to full cent. So instead of 2.05 cents, 2.05, it goes to 2.1, 2.2. 2.01, 2.02, sorry, you know what I mean. It moves in 1 cent increments instead of half cent. And that's sort of a key psychological level. Then you got the $10 level, and they're just big round numbers. And for whatever reason, there's just a pull to get to that level. And then you typically see a big rejection off that level as well. One of the old school trades that I used to do is when a stock gets to 10 cents its first time, there's a pullback to 9.2. So if you remember, I was talking about the double bottoms, how they just used to be really stupid and now they're just kind of a thing again. That's kind of like the 9.2 level. So 9.2 has been a thing lately. So a stock will pull back to 9.2 and then retest 10. So these kind of setups I take almost every day of the week when the market conditions are right. And I consider these almost free money trades because you don't have to think too hard. Like a stock hits 10, where am I going to buy? It's like, I'm not going to buy 10 or 9.9 and hope it goes to 10.5. I'm going to take the easy trade. The 9.2 pullback, the worst case scenario pulls back to 9 cents. So 8.9 is the stop loss. So 3 ticks stop to get 8 ticks reward. And it just works so consistently that, you know, when they're there, I consider it free money.
It sounds like, just bringing that all back together and what you said at the start, it just seems like you're doing more pattern recognition, even at that level, around those levels and things like that. You have just been in the market, you watch, and that has allowed you to draw patterns, and they're things that then influence your trading to go on. That's right.
You see the same thing over and over and over again. You'd start, you'd be stupid not to take the trades that you keep seeing that work. You don't ask questions as to why they work. They just do. The amount of time someone's asked me is, why 9.2? Fuck, I don't know. Why mountains? Why do they exist? I don't fucking know. I'm sure there's a really deep explanation to it, but I'm not going to go find out. There's a mountain, climb it. There's 9.2, buy it. Yeah. You fucking idiot.
And mate, that seems to be another, and again, I don't say this in a bad way, but a very simple strategy. Have you kind of migrated to those kind of strategies to help with that psychological, mental side of trading full time?
Yeah, I guess you could say that.
Does it take a load off your brain, not having to, more complex trading strategies? Or?
Well, it's funny because the emotional aspect is always there. It never goes away. I think it's just a matter of managing or realizing what it feels like, and then just accepting that it's there and ignoring it. So that it sounds really simple to go, hey, a stock just shot up from 6 cents to 10 cents and then buy the 9.2. But I guarantee if you write down that trade on paper, that's what Demon says to do. And then you look at the order book when it's happening, you're going to shit bricks. You're not going to want to take that trade. I guarantee the first 3 times you see that happen, you're not going to want to take that trade. Even I don't want to take that trade when I look at it, because you look at the order book and you're like, wow, it's really thinned out. You've got rug pulls from 9.8 to 9.6. They're all just gone. There's no liquidity. You've got like a 50K stack. More like a 250K stack at 10 cents now, and you've got maybe just a few thousand shares, maybe 10K at 9.3, 4K at 9.2, and the order book just looks absolute garbage. So that emotional aspect doesn't go away because I'm seeing the same thing every time. And based on what I know about tape reading and just trading generally, is when you see a tape like that, it elicits a response of don't do it, that's terrible. But then you got to sort of push past that and just execute it anyway, because the number of times that trade has failed is super low. And what you'll see is I'll be one of the first people in at 9.2, 9.3, sometimes 9.1, depending on how hot the book is. But generally it's not hot. And I'll be the first one in, and then the liquidity will come in, and then I'll sort of help push a stock to the upside. And that emotional aspect doesn't go away. It just doesn't. It's about managing it, learning that it's there. And I think that's one aspect that people don't take seriously. They'll look at their P&L, they'll look at their trade reviews, they'll talk about the trade but they won't talk about how they felt about it. They won't talk about how gut-wrenching it was to be the only person in at 9.2 and there's just practically no liquidity, and maybe like $5,000 could send it down to 8.8 or something like that, and you'll just be down a significant chunk of capital. And it's just, I don't think people respect that emotional aspect very much, and I think that's one of the core aspects of trading, is acknowledging it and ignoring it, and it's way harder than it seems. And I feel bad about this JBH trade because I just got sucked out.
That's all right. That's the game of trading. It's good that we can actually visualize it. So that's great. You touched on the psychological stuff, and I think this is probably somewhere we might spend the remainder of our podcast just on psychology. Firstly, before we get into your psychology, new traders, even seasoned traders, what were some of the things that helped you develop your psychology in terms of any tools or resources that you would like to potentially pass on to those watching or listening that you think could have been instrumental in how you were able to develop the psychological side of your trades?
I think it's, for me, I didn't have resources when I first started. I had nothing. Really, I had nothing. And we're talking 2016. There was nothing on YouTube. There were some books, but they were US centric. You got your Mark Minervini and stuff like that, and they weren't really day trading. So it's kind of like just learning the ropes myself. And I think it took me a lot longer to get to where I am than it would take someone today, if they started, because it's just the wealth of information online. But the psychological aspect, that came as just a form of self-awareness, that just have to recognize that it took me many times to get that 10-cent trade right. From that 9.2 pullback, I think, is a great example, because I know it works with such a high percentage, like high percent chance of working. And I sort of recognized that very early, but I also recognized that I just couldn't take the trade for that very reason. That's kind of why I brought it up, is because it's probably one of the most difficult ones to deal with from an order book perspective. So if you're a tape reader and you're an order book trader, that's going to look horrific every single time. And it's funny because you look back at it when you actually take the trade, or not when you take it, but if you take it and get stopped out, or if you look at it, the 9.2 is good, but you don't take it. And then at the end of the day, you look at it and you go, wow, that worked again. And again, I couldn't take it, or again, I got stopped out too soon. Then it just becomes a matter of just reflecting on it and just going, what went wrong? And it's like, oh, I was actually too scared to take it. Or, yeah, it's just basically too scared to take it. And then it's just about identifying why I was too scared to take it. So it came really as a matter of just self-reflection, really, and understanding that the setup is there, the chart's there, the 9.2 is there, but I'm just not taking it. Why am I not taking it? And I think that's a question a lot of people don't ask themselves, is why didn't I take it? And they didn't really analyze why. So in terms of psychological stuff, it really is just self-taught. I can't say that I've read something that's really helped or anything. It's about pushing past that emotional aspect and just, like I said, there's no getting past that gut-wrenching feeling of sometimes taking a really good trade when it looks horrific, because it's really good statistically. And that's just such a barrier for some people. And it was a barrier for me for a long time.
Okay. Yep. It sounds like, although you're discretionary in nature in the way that you trade, and perhaps you don't do this, but it sounds like you've seen occurrences happen 5-6 times, they work more times than they don't. And that in itself, creating that system where you understand what the risk reward of trades coming out is, almost the thing that you lean on when you do actually take a trade and you're going against the grain. You recall those previous instances, and that almost allows you to have the confidence and gives you the psychological edge to then execute, regardless of how you're actually feeling in the moment. Does that sound right?
Yeah, that's right. That's right. Double bottoms were a perfect example. Double bottoms, it's, you got 18 months you're used to looking at this thing and just going, it's not going to work. And then you've got only like 3 data points in the last week where you're like, it did work. And, you're fighting against 3 days of data versus 18 months of where you'd be telling yourself you're a real fucking idiot for taking the trade. But the last 3 days are your data points and you're like, well, it's a trend now. And then you execute it. But like I said, it's a gut-wrenching feeling sometimes because you feel stupid. Even though the risk management's there and you're like, well, okay, it's a 6-cent stock. I've got 2-cent risk. I've got, significant upside, but it still feels stupid. It still feels wrong. So that is an aspect that really needs to, I can't emphasize enough how significant of an aspect that is to trading. It's far more important than finding the pattern.
All of this that you have going on and you just sort of have recalled it from your head, has it always been in your head? Is there any things that you use? Do you write? Do you journal? Do you track trades? Is there anything like that you use? Or
You've got a background in IT as well, don't you? Do you use any technological advancements made in trade as well?
No software or anything like that. The only thing I do, like I mentioned, I recently opened up a channel, and the only reason I've really done this is I've opened up a channel to take notes on trades that I've looked at, like the peak market cap and stuff like that. I've only started doing that because there's more and more commodities that are just being of interest. For example, rare earths weren't really a thing back in pre-2020. Uranium wasn't really that interesting back then either, so I didn't need to know uranium grades. It was quite simple. It's just gold, a bit of silver. Lithium was hot for about a year or two, and that was it. Those are really the 3 commodities that were interesting. Maybe graphite, I think, peaked for a little bit, but now it's far more minerals. You've got copper coming in, nickel is of interest, uranium, rare earths, and niobium, particular rare earths, NdPr, neodymium, praseodymium, and stuff like that. So finding out the grades of those. So it's getting a little bit more complicated as the market is finding out more interest in different commodities. So I've started writing out peak niobium grades, for example, because who knows when I'll ever see that again. But niobium is still relatively hot. There's not much in terms of occurrence that people are drilling for it. So I've got it there as a sort of a reference. So when I type in Discord, in channel commodities, type niobium, and I'll have maybe 6 stocks, 5 stocks that have had certain drill results that did really well, and I've got some sort of reference point for what I can target on the next niobium trade.
Yeah, okay. Mate, we've obviously heard a lot about your progression from both learning strategies and pattern recognition as well as the psychology. Fast forward today, what is still, if I was to say what's the biggest challenge for your trading today, what comes to mind?
Opportunities. I think finding the right opportunities and adjusting to a lower liquidity environment. That's been pretty terrible as of late. I'm seeing less price action on stocks that should have really good performance based on their news catalysts. And that's not just because it's December and January. I'm talking, it's for most of 2023. Performance has been unusual for catalyst news events. And that's it. Just finding opportunities, I think. That biggest challenge by far.
Yeah. And so 2023, obviously in reflection now, is something with a lot less opportunity. And you said that you spent more days out of the market than ever before. Do you find yourself adapting your trading style too much, or is it more just a matter of being able to preserve capital for when those opportunities have to arrive, they do come about again?
It is mostly about preserving capital, but it's waiting for when those conditions change. I mean, we've had like pockets of heat in 2023 where, let's say, lithium speckies were just stunk. So it's like take advantage of that 2-week period where lithium's performed really well. Or copper, for example. I mean, copper's now kind of dead, which is unusual. Like, I've never seen that before. So copper stocks just aren't performing anywhere near like they used to. But when there's a little spike for nickel and copper, then just take advantage of that spike. And, sometimes it's you're going to be going hard on maybe 2 or 3 stocks, and then on the fourth one, it's going to perform really badly and take a bit of a dig on the P&L. But it is what it is. Unfortunately, I do miss the old days of pre-2020, because it feels like 2020 and 21 had such a surge in both users, the amount of capital traded, liquidity went through the roof. So it feels like if you were to bring out like a chart or a graph, it would kind of like spike to the upside. And I think a lot of people would be expecting it to drop back to the mean, but it's just going to overshoot to the downside. And I think that's what 2023 is. It's an overshoot to the downside, in both in terms of liquidity and in terms of market participants, because I've got a kind of a unique insight, I think, into how many traders are watching YouTube content, for example. There's just a massive decline in 2023. There's a massive decline in the amount of users joining Discord. A reasonable decline in Twitter engagements for ASX-related content. So I've kind of got an insight into just the actual impact of just the amount of retail traders in the market. So,
and do you think that's existing traders dropping out of the market, or the new traders just not being interested? They traditionally are.
I think it's both. I think there's just so many people that got involved in 2020 and 2021. I think people who dropped out probably told their mates who might have been interested that, hey, yeah, no, it's a bit of a scam or something like that, But yeah, it's really unfortunate, but it's both. A lot of 2020 traders, 2021 as well, a lot of them have dropped off, and Discord is a good example. I can name so many regulars that have just disappeared off the face of the earth from trading. So a very, very large percentage of them didn't make it. That's just what it is, right? That's the game. 2 years sometimes just isn't enough.
So you almost use those numbers coming through your Discord and YouTube as a sentiment indicator to see, how much sort of fluff liquidity is in the market there that could drive sort of, what would usually be a 10-cent move, for example, it's only sort of been a 6-cent move or something like that. Is that right?
These days, I'd use probably Twitter as a better real-time engagement. I think Discord and YouTube are great for a macro view of what's happening with market participants. Twitter's really good as an example for that uranium stock, the I-88 trade that happened. If I can...
Sorry, mate, I'll just pause you there. Sorry,
sure.
Yeah, your hour is up. If you wouldn't mind closing your positions. I know that we had a bit of technical difficulties there halfway through.
That's all right.
My apologies. And so closing out there, we have, 20,000 down to 19,801. And so that, mate, puts you right there in fourth. No, fourth. You're not last. Don't worry. We've had worse. But no, thanks so much for that. You can sort of see from what you were talking about at the start, it was just sort of... It played out, I guess. Like if you look at that,
it worked quite well, didn't it? It's just that you probably just got stopped out pretty much on the low there, didn't you?
Yeah, that was I was trying to exit a little bit too tight. I think it was around 30, dipped down to 26. So that was a 10-cent dip, actually, a much bigger dip than I was expecting. But it is what it is. So you can see it bounced in the middle of nowhere. So, a little wick from one candle makes sense. A second one is just a little bit too much, but it is what it is. It cost me very little, and you can see the reward for that one would have been far more, but it is what it is.
It's holding up. The index is down, 85 points. So
yeah, it would be really interesting to see how it ends at the end of the day. I really think 59.75 to 59.90 would be sort of the targets, but poor execution.
Conceptually, that was great insight. And yeah, thank you so much for sort of getting in there at the start and sort of tracking exactly what you thought might prevail. But yeah, just execution at the end of the day caught you there.
Timo, can I just ask you, and I asked this because I was watching one of your videos and you made an offhand comment that, that's because I'm a shit trader. And I know you're only joking there, but that's something that I'd say as well. How do you view yourself? Like, what do you think are your strengths? Do you think you're an excellent trader? How do you view yourself currently in 2024?
Very marginal trader. Very average. I don't even know. So definitely like there's just I can name quite a few people that are so substantially ahead of me, and they probably always will be. Like I think I plateau, and that's it. Like I know some people just go exponential, and that's really awesome to see. I don't have that. I'm not an exponential trader. I don't get twice as good as last year or the year before that. The curve doesn't just go like that. Sort of just leveled off, and I'm very happy with that.
Mm-hmm.
I'm perfectly fine with it. So
yeah. And what do you see with those successful traders or people that you view as successful? Is there any kind of traits, or what do you see in them?
It's hard because I don't really know. So the guys in my Discord that have been trading for 20 plus years have also kind of hit a plateau. They kind of, they're not going, plus 20% year on year or anything like that. But, they trade substantially more than I do as well. So, I like to hang around traders that perform better than I do. And I would hate to be the top dog, because that means I can only get worse from there. So if I trade with people that have been in the markets for 20, 30 years, I've got people that know way more than I do, and there's just always more to learn. But in terms of what they do, I couldn't tell you what they do. I guess that's why I'd have to ask and hang out with them. So I guess it just really comes down to experience. I think if I was to guess, I would say the personality traits they have might be more conducive to trading, or to that level of performance. They just might have that personality, or that's all I can think of really.
Okay.
Marta, can you ask your $1 million question? I'm really interested to hear what Demo has to say about that.
Well, we just kind of generally asked Demo what, looking at the market and the state of the market today, what if you had $1 million and we said come back in a year and try and do what we've done in an hour today? What any thoughts?
Just anything, right? Any particular stock or any particular direction, or just anything?
Could be in the bank.
Could be in orange juice futures. Big upside potential.
Fair.
Jokes.
For me,
that was a joke. Not financial advice.
Not financial advice.
I really, really dig the state of micro cap goldies at the moment. Like I've talked about it for the last month or two. I've been trading, for example, the stock AUN. Again, I don't know the name, so I can't show you the chart, but I've been trading that one from 2 cents to 3 cents, and then 2 cents again to 2.9 or whatever. But these goldies have just so much gold in the ground that are heavily undervalued. Now we're looking at stocks that are trading at based on actual existing gold that's inferred in the ground or indicated. We're looking at maybe like $8 an ounce, and maybe as low as $6 for some stocks, and they'd be typically trading at, in terms of market cap, that is, so $8. Sorry, let me bring up. I actually wrote this down. I can't remember if it's $8 an ounce exactly. So it's that's it. So they used to trade at $40 to $50 an ounce for gold, and that's when gold was trading at about 1,400 US. So a lot of goldies are super undervalued. So I'd be piling in there. Not to suggest AUN is the best of them, but that's just one example of just something I've been sort of range trading. That's purely based on just how low the gold I guess sentiment is at the moment. So I think it's a matter of when, not if, these goldies recover. And there's probably about 10 goldies that I found that are super undervalued. So it's worth shopping around for, and I wouldn't surprise me if they broke out sometime in 2024.
Okay.
So $1 million spread across 10 gold speckies.
Right, that was AUN, and that was financial advice.
Absolutely.
Okay, thank you.
No, there's not. No. Oh, no. ASIC will cross us off before we even get started. Goodness me. Jeez. Mate, real quick, your 1 month challenge. Can you just talk me through conceptually the reasoning behind that?
Yeah. So I guess I just wanted to highlight how how it doesn't matter what your account size is to an extent. I mean, it sucks when you don't have margin, if you have 100% margin on speckies and stuff like that. But even with an account like that, I still managed to push it to 3K. So I did a video, for those who don't know, from, I guess it was just called the 1 month challenge. And I just wanted to highlight what I can do in 1 month with that account. I think a lot of people estimated it might, be plus 30% or something like that. But to take it to plus 200%, show all the trades that happened, every single trade that happens, screen cap it and all that. So the idea there is just, I think one of the biggest problems with newer traders is they feel like they need a 10K account, a 50K account, or just like lots of capital. But, if you can't make money at $100 a tick or $10 a tick, why would you trade in larger denominations or larger size per tick? So why not trade at $2 a tick? If you're still not profitable at $2 a tick, you're going to have a problem trading anything higher. Yep. So the advantage is liquidity is going to be less of a problem. So you can sort of build into it as well. So as you build up that size, you can focus on liquidity more and more, or, focusing on what's in the order book and managing your size that way. But I think, it really just goes to highlight that you don't need a large account to be profitable.
Yeah. No, that's great. And it's just I guess, you sort of, if you are a newer trader, to earn your stripes, don't go in guns blazing, because, if you can't make $10, you can't make 10,000 by the sounds of it.
And it really is just, a lot of it was range breaks that I just showed you today. A lot of it was range break trades. So really basic stuff with catalyst news events to make it more exciting, of course. But so it's not complicated. It's not hard. No fucking MACDs, no RSIs, no indicators or anything like that, except maybe VWAP and volume, but that's about it. Just keep it simple.
And if people want to follow that, mate, is that on your Discord or Twitter or YouTube or?
On Twitter at Demoniaco ASX. On YouTube, it's at Demoniaco. And that's it.
All right.
Yeah.
You can find the links to Discord, in both of those social media.
Yeah, and I'll put them in the description of the video and in the show notes on the audio versions as well, for those who are interested in following you and sort of joining those communities. I think it's probably a really good starting place. There's a lot of like-minded people there, and it's a great way to sort of get your taste that there are other traders out there when it is quite a lonely exercise. So, mate, thank you so much. It does, like, looking back on the hour that was what you're telling and displaying to us on the chart there, sort of has played out great. I mean, we still got the circle around that perfect pivot point where I had to sort of cut you out there. So my apologies on the hour there. Mate, thank you so much for coming on. Really, really appreciate it. And, all the best for your 24 trading. And, for those listening and viewing, make sure you go check him out. If you like what you saw and heard today, please, comment, subscribe, and talk about who maybe we should be sort of talking to next. And we'll keep soldiering on. I think Marto and I are aiming for an episode a week for 24. So there's obviously a lot of successful traders out there. We've just got to convince them to come on. So thank you for being so generous with your time today, mate. I appreciate that.
Thanks, Dan.
No worries. Thanks, guys.
Cheers, buddy.
Easy. Cheers, guys.
Thanks, fellas. Bye.